If you get value from this channel, the best way to support it is simple. Subscribe, all right? Let's get into what just happened because the last 72 hours have been some of the most violent I've ever seen in precious metals markets. And I've been watching these markets for a long time. Today we're going to break down the 26% crash in silver that happened in less than a single trading day. We're going to talk about the 9% drop in gold, which was the worst single-day move in over a decade. I'm going to explain why Chinese speculators are at the center of this entire story and why the mainstream explanation about the Fed nomination is only about 20% of the truth. We're also going to look at the options market mechanics that turned a correction into a massacre. And I'm going to walk you through the exact conversation I had with a family member who almost blew up his entire position chasing this rally at the worst possible moment. But here's why you need to stay until the end. First, I'm going to tell you what I think actually happened behind the scenes, the part that most financial media is either missing or choosing not to say. And second, I'm going to give you a framework for navigating what comes next, because this story is not over. What happens when Shanghai opens could change everything, and if you're not prepared, the next move could hurt even worse than this one. Also, make sure you check the description below this video. I've put a link to our WhatsApp community where you can get real-time alerts and updates when things move fast. I've also linked our Twitter account, now called X, where I post quick takes and breaking news that doesn't always make it into these longer videos. If you're serious about staying ahead of these markets, those two links are your lifeline. Okay, let's talk about what your eyes saw on the chart because the numbers alone are hard to process. Silver dropped 26% in a single day. That's not a typo. 26%, that's the biggest single-day drop in the recorded history of the silver market. We're talking about a move that erased weeks of gains in less time than it takes to fly from New York to London. Gold dropped 9%, which was its worst day in more than a decade. And copper, which had spiked past $14,500 a ton just days earlier, came crashing back down so fast that traders literally couldn't execute orders. One of the heads of trading at a major bullion refiner, a company called Harrius, said something that stuck with me. He said, "Gold is supposed to be a symbol of stability, but a move like this is not a symbol of stability." And he's right. When the asset people buy for safety becomes the asset that moves like a meme stock, something has fundamentally shifted in the market structure. Now, here's the first cliffhanger I want you to lock in. When you see gold, silver, and copper all crash together in the same window, that's not millions of individual investors making the same decision at the same time. That's machinery. That's positioning, that's forced selling. And the why behind that forced selling matters more than the candles on your chart. The mainstream explanation you've probably already heard is that President Trump announced he was nominating Kevin Warsh to lead the Federal Reserve, and that sent the dollar higher, which pressured metals. And look, that's not wrong. That did happen. The dollar did strengthen. But if you think a Fed nomination alone caused a 26% crash in silver, you're missing about 80% of the story. Here's what actually set the stage. For the past several weeks, maybe even months, Chinese speculators have been piling into metals at an absolutely historic rate. I'm not just talking about institutional money. I'm talking about individual retail investors in China, large equity funds that normally trade stocks suddenly venturing into commodities, and a wave of momentum-driven buying that pushed gold, silver, and copper to levels that made no sense from a fundamental supply and demand perspective. Gold hit $5,500 an ounce. Silver topped $121. Copper hit $14,500. These weren't prices driven by industrial demand or mining supply constraints. These were prices driven by pure speculative momentum. Hot money chasing hot money. And here's the part almost nobody says out loud. When Chinese investors pile into a trade, they pile in hard. The buying is aggressive, leveraged, and heavily concentrated in derivatives. And when they decide to take profits, they take profits just as hard. The same mechanics that pushed prices up parabolic are the same mechanics that can crash prices in an afternoon. One former head of commodities at Bridgewater Associates explained it perfectly. He said, "As prices squeeze higher, dealers have to mechanically keep buying more to hedge their positions. And that explains why prices go up so fast." But then he added the part that matters. It also explains why prices go down so fast. That's the key. This wasn't a normal correction. This was a leverage unwind. This was a momentum trade that ran out of buyers at exactly the wrong moment. And when the selling started, there was nobody left to catch the falling knife. Now let me give you some context on just how frenzied this market had become before the crash. The iShares Silver Trust, which trades under the ticker SLV, is the largest exchange-traded fund backed by physical silver. On a normal day, it might see a couple $1 billion in trading volume. On Friday during the crash, it saw more than $40 billion in turnover. That made it one of the most traded securities on the entire planet, not just in commodities, on the entire planet. Options activity was even more insane. Call options on SLV, which are basically leverage bets that silver will go higher, had more trading volume than the main ETF that tracks the Nasdaq 100. Let me say that again. More options volume on a silver fund than on the index that tracks Apple, Microsoft, Nvidia, and all the other tech giants combined. And here's where the mechanics get dangerous. When there are a lot of outstanding call options, it creates conditions for what traders call a gamma squeeze. As prices rise, the dealers who sold those calls have to buy the underlying asset to hedge their risk. That buying pushes prices higher, which forces more hedging, which pushes prices higher. It's a feedback loop that can send prices parabolic very quickly. But here's the cliffhanger. That same feedback loop works in reverse. When prices start dropping, those same dealers have to sell to adjust their hedges. That selling pushes prices lower, which forces more selling. And suddenly, what looks like a normal pullback turns into a waterfall. That's exactly what happened on Friday. The machine that pushed silver to 121 on is the same machine that crashed it to $90 in less than 20 hours. Now let me tell you about my uncle, because this is where things get personal, and this is where the lesson becomes real. My uncle has been interested in precious metals for years. He's not a trader. He's a regular guy who works a regular job and has been slowly building a position in physical silver as a long-term store of value. Smart approach, patient, disciplined. At least that's how he used to be. About 3 weeks ago, he called me. He was excited. Silver was ripping higher every day. Gold was making new highs. He'd seen posts on social media showing people making 1,000% returns on silver calls, and he wanted in. He told me he was thinking about taking a big chunk of his savings, a significant amount, and putting it all into silver, not physical silver, paper silver options. He wanted to catch the wave. I asked him one question. What's your exit plan? He didn't have one. His plan was basically to buy and watch it go up, and that's when I knew he was about to make a mistake that could set him back years. I told him something that I want you to write down. If your plan is to buy when you're excited and sell when you're scared, the market will take your money. You're not investing. You're gambling. And the house always wins against gamblers. We had a long conversation. I walked him through the difference between physical silver and paper. I explained that physical silver, the actual metal you can hold in your hand, is a long-term position. It's something you hold through volatility because you're not trying to time the market. You're trying to own something real outside the financial system. Paper silver, whether it's an ETF, a futures contract, or an options position, is a completely different animal. It's a trading vehicle. It moves with leverage, and it can go to zero if you're wrong at the wrong time. I told him if he wanted to add to his physical position, we could talk about how to do that intelligently. But if he wanted to gamble on options because he saw some screenshot on Reddit, he was going to learn an expensive lesson. He pushed back. He said, everyone's making money. He said, this time is different. He said, silver is going to 150. And he didn't want to miss it. I've heard those words before. Every market cycle, people say, this time is different. And every time, the people who believe that are the ones who get hurt the worst. So I made a deal with him. I told him if he was determined to add exposure, we would do it my way. We would cut his planned position in half. We would only buy physical metal, not paper. We would use a product type with lower premiums per ounce, and we would not chase price. We would wait for a pullback. He agreed reluctantly. For the next 2 weeks, he watched silver keep climbing. Every day he texted me saying he should have gone all in. Every day I told him to be patient. Then Thursday came. Gold suddenly dropped more than $200 in about 10 minutes. Silver started wobbling, and my uncle called me in a panic asking if he should sell everything. I told him to do nothing. Absolutely nothing. I told him the worst thing you can do in a fast-moving market is make decisions based on emotion. If you have a plan, you stick to the plan. If you don't have a plan, you sit on your hands until you do. Friday morning, the crash accelerated. Silver was down 20% and falling. My uncle was convinced it was going to zero. He wanted to dump his physical silver at a loss just to feel like he was doing something. I told him that's exactly what the market wants you to do. The market wants you to buy at the top when you're greedy and sell at the bottom when you're scared. That's how wealth transfers from weak hands to strong hands. And he needed to decide which kind of hands he wanted to have. We sat on the phone together and watched the market. We didn't buy, we didn't sell, we just watched. And I explained to him what was actually happening. The leverage was unwinding, the momentum traders were getting flushed, the algorithms were feeding on each other. This wasn't the end of silver. This was the market taking out the tourists. By the end of Friday, silver had stabilized, at least temporarily. My uncle still had his physical position. He hadn't chased the top. He hadn't panicked sold the bottom. And he learned a lesson that will serve him for the rest of his investing life. Here's what I want you to take from that story. The people who got destroyed on Friday weren't the people holding physical metal as a long-term position. The people who got destroyed were the people who chased a parabolic move with leveraged positions and no exit plan. They were playing a game they didn't understand against opponents who do this for a living, and they paid the price. Now let me give you a framework for thinking about what comes next, because this story is far from over. The first thing you need to understand is that what happens in Shanghai matters more than what happens in New York right now. Chinese demand has been driving this entire rally. Chinese selling triggered this crash. And when Shanghai opens on Sunday evening New York time, we're going to find out whether Chinese buyers see this as a buying opportunity or whether they're ready to dump more. Here's a piece of context that's critical. Chinese exchanges have daily price limits on silver contracts. That means if the price on Friday in New York crashed faster than Shanghai's limits allow, Shanghai's prices haven't fully caught up yet. When trading opens, there could be additional catch-up selling that extends the drop, or there could be aggressive buying from investors who see the lower prices as a gift. Nobody knows which way it's going to go. Anyone who tells you they know is either lying or selling something. But here's what I'm watching. Reports from Shui, which is a major bullion trading hub in China, suggest that tightness in silver has eased somewhat. There's more selling than buying over the weekend. But importantly, there are no signs of panic selling. And silver prices in Shui are still trading at a premium to exchange contracts. That last part is significant. If physical silver is trading at a premium to paper silver, it means there's still underlying demand for real metal, even while the paper market is crashing. That disconnect tells you something important about who's selling and why. The other thing I'm watching is what Chinese banks are doing. Several major banks, including China Construction Bank and Industrial and Commercial Bank of China, announced fresh measures on Friday to curb risks tied to retail gold accumulation products. They're raising minimum deposit amounts. They're implementing quota controls. They're telling customers to heighten risk awareness. When banks start restricting access to a product, it usually means they're worried about their exposure. And when banks are worried about their exposure, it means the system is under stress. Now, here's my take on what this all means for you. If you're holding physical precious metals as a long-term store of value, this crash changes nothing about your thesis. The reasons people own gold and silver haven't changed. Currency debasement is still happening. Government debt is still exploding. Central banks are still buying gold at record rates. Geopolitical instability is still accelerating. None of that went away on Friday. The only thing that changed was the price on a screen. If you were thinking about adding to a physical position, this pullback might actually be an opportunity. But, and this is critical, you don't catch falling knives. You wait for stabilization. You wait for the panic to subside. And you buy according to a plan, not according to your emotions. If you're trading paper metals, options, futures, leveraged ETFs, you need to understand that you're playing a different game entirely. That game requires discipline, risk management, and an acceptance that you can be right about the direction and still lose money because of timing. Most people should not be playing that game. And if you are playing it, you need to size your position so that even a 50% drawdown doesn't wipe you out. Here's a practical checklist I want you to use before you make any decisions this week. First, define your purpose. Are you buying physical metal as a long-term store of value, or are you trading for short-term profit? Those require completely different approaches. Don't mix them up. Second, understand your all-in cost. If you're buying physical, you're paying spot price plus a premium. That premium can vary widely depending on what you're buying and where you're buying it. Your break-even is not the spot price. It's the spot price plus whatever premium you paid. Most beginners don't understand this, and it leads them to make bad decisions. Third, never commit your full position on your first buy. Split your purchases across multiple price levels. If you're right, you still win. If you're wrong, you have ammunition to average in at better prices. This one rule has saved more portfolios than any technical indicator ever invented. Fourth, ignore the noise. You're going to see 100 different explanations for why this crash happened and what's coming next. Most of it is speculation dressed up as analysis. Focus on what you can control and what you can verify. Watch the physical premiums. Watch the delivery times. Watch what's actually happening in the supply chain. That's where the real information lives. Fifth, have an exit plan before you enter. If you don't know at what price you'll take profits or cut losses, you're not trading, you're hoping. And hope is not a strategy. Now let me talk about something that's bothering me about the mainstream coverage of this crash. Every headline I've seen blames the Fed nomination. Trump nominates Wersch. Dollar goes up, metals go down. Simple story, easy to understand, and almost completely missing the point. Yes, the worst news was the trigger, but the trigger is not the cause. The cause was weeks of speculative excess, leverage accumulation, and momentum chasing that had pushed prices far beyond any reasonable fundamental value. The worst news was just the match. The gasoline had been poured for weeks. And here's the part that really bothers me. When prices were going up, nobody in the mainstream media was asking whether the rally was sustainable. Nobody was warning that Chinese speculative flows were driving prices to irrational levels. Nobody was explaining the gamma squeeze mechanics that were amplifying every move. They were just reporting higher prices like it was all normal and healthy. But now that prices are crashing, suddenly everyone has an explanation. Suddenly everyone saw it coming. Suddenly it's all obvious in hindsight. That's not analysis. That's storytelling after the fact. And if you're making decisions based on that kind of coverage, you're always going to be one step behind. This is why I do what I do with Financial Crux. I'm not here to tell you a story that makes you feel smart after the move already happened. I'm here to help you understand the mechanics before the move so you can position yourself intelligently rather than react emotionally. Now let's talk about what might happen next, because there are several scenarios we need to consider. Scenario 1, Shanghai opens weak and the selling continues. If Chinese investors see Friday's crash as confirmation that the rally is over, they could dump more positions into the Asian Open. That would create additional downside pressure and could test lower levels we haven't seen in weeks. If this happens, you need to be prepared for more volatility and more pain if you're positioned long. Scenario 2, Shanghai opens with aggressive buying. The pullback ahead of Lunar New Year could be seen as a buying opportunity. Retail investors who missed the rally might step in to buy the dip. If this happens, we could see a sharp bounce that catches the bears off guard. But be careful, because bounces in a downtrend can be traps. Just because price goes up doesn't mean the correction is over. Scenario 3, Shanghai opens mixed, and we chop sideways for a while. This is honestly the most likely scenario in my view. After such a violent move, markets often need time to digest what happened. We could see days or even weeks of range-bound trading as the market figures out where fair value actually is. If this happens, the right move is patience. Don't force trades in a choppy market. Regardless of which scenario plays out, the key is having a plan before the market opens, not after. If you wait until you see what's happening to decide what to do, you've already lost. The market moves too fast for real-time decision-making. You need to have your if-then scenarios mapped out in advance. Here's what I'm personally doing and thinking about right now. I'm not buying anything aggressively until I see at least 3 days of stabilization. I want to see the panic selling exhaust itself before I put new capital to work. I'm watching physical premiums carefully. If premiums stay elevated despite the spot price crash, that tells me underlying demand is intact, and this is more likely a paper market phenomenon than a fundamental change. I'm keeping dry powder available. Cash is a position. Being able to buy when others are forced to sell is one of the biggest advantages you can have as an individual investor. Don't be in such a hurry to be fully invested that you can't take advantage of opportunities. And I'm ignoring anyone who claims to know exactly what's going to happen next. Anyone who tells you silver is going to $50 or silver is going to $200 with certainty is selling you something. The honest answer is that nobody knows. We can have frameworks, We can have probabilities, but we can't have certainty. One more thing before I let you go. In the next video, I'm going to break down the physical versus paper dynamic in much more detail. I've been getting a lot of questions about whether paper claims on silver can actually be settled in metal, what happens when delivery demand exceeds vault supply, and whether the price you see on your screen actually reflects reality. Those are important questions and they deserve a full video to answer properly. So make sure you're subscribed and you have notifications turned on so you don't miss that one. And again, check the description for the link to our WhatsApp community and our Twitter account. When things move fast, that's where I post real-time updates that can't wait for a full video. Let me leave you with this. The market just did something historic. A 26% crash in silver in less than a day, the biggest single-day drop on record. And for most people, the lesson will be the wrong one. Some people will conclude that silver is too dangerous and they should never touch it again. Those people will miss the long-term opportunity because of short-term volatility. Other people will conclude that they need to trade harder and faster to catch the next move. Those people will blow up their accounts trying to be smarter than the machines. The right lesson is much simpler. Understand what you own. Understand why you own it. Have a plan that accounts for volatility. And don't let emotions drive your decisions. Silver didn't stop being silver on Friday. Gold didn't stop being gold. The fundamentals that made these assets attractive before the crash are the same fundamentals that exist after the crash. What changed is the price, and price is just one variable in a much bigger equation. That's what edge looks like in these markets. Not predicting the future, but staying calm when the future arrives faster than anyone expected. I'll see you in the next video. Until then, stay disciplined, stay patient, and let the math outrun your fear.